debt market after 50 basis point rate cut in last credit policy has gone up. And after President levying 25% penalty, equity market has bounced back. I think I'm becoming too old now to predict what kind of market moves will happen in the short term. But nevertheless, first of all, we would like to thank you for your wholehearted support on Kotak Income Plus Arbitrage Fund of Fund. It is less than a year since we relaunched this fund, and it has collected 5,000 crore in AUM. And in today's market, it is one of the best performing fund. Coming to global economy, PMIs continue to remain low. It is in contradictory phase since last 3 months. No wonder global economy is slowing down from 3.3% growth in 2024. Growth will come to 3% in 2025. Quite likely chances that 2026 growth will be revised downwards. Growth requires investment. Investment requires capital. But most countries around the world, when you see, they are already leveraged. That means even the past growth has been created by debt, and the limit for some of the higher indebted countries is limited. Courtesy this kind of uncertainty, different countries have different monetary fiscal policy. Some are hiking interest rates like Brazil and Japan. Most are cutting interest rates from US to UK to Germany to France to Korea to China. But while their equity markets by and large has delivered positive return this year, their bond yields have moved in different direction. Undoubtedly, the world is getting decoupled on the fixed income side. China, the second largest economy, is seeing the impact of tariff. Their exports to European Union, Japan, and US is declining. China's manufacturing margin is contracting. They are creating capacities, but they are not making much profit. Consequently, their listed manufacturing capex has started coming down, albeit directed by the government, pushed by the government. They have created capacities which can service majority of their demand as well as half the world's demand. No point in creating more capacity. As investment has started cooling off, obviously loans, credit also starts coming down. The world now believes that as Chinese economy has expanded, their rate of growth from here onwards will be in low single digit. There was a time when China was growing in double digit between 2005 to 2010. Then it started growing in single digits between 2010 to 2020, but they were still higher single digits. Now it looks like that China will be sliding in lower single digit growth. Coming to US economy, it's a services-led economy. A large portion is domestic services. Manufacturing as well as trading are substantially small part of American economy. Right now, despite the bravado of American policy making, their economy is witnessing many headwinds. Tariffs can hurt America as well as its partner. The consumer confidence is function of equity market as half the net worth is invested in equity. Student loans defaults are rising and demand for student loan waiver, just like our farm loan waiver, is increasing. The real problem of America remains they are spending much more than what they are earning, and they are financing it by way of debt. They have become addicted to debt. $1 of debt now produces 50 cents of GDP. US economy shrank in the first quarter of calendar year 2025. Second quarter numbers are yet to come. Overall, it's an economy where there are mixed signals. Corporate earnings are deteriorating. Consumer sentiment is declining. CEO confidence has come down with tariff, and consumers are worried about unemployment. We believe in US, if tariffs continue to bring uncertainty, it will have some adverse effect on American economy as well. As of today, the wealth effect is probably supporting American consumption as their equity markets are high, house prices are high. But over a period of time, as that wealth effect fades, the tariff impact will be visible. Why are we talking so much about tariff? Well, it has almost reached as high as it was in the Great Depression time. No wonder the world suffered because of American tariff, but America also suffered because of tariff and moved into what is known as Great Depression. This is the IMF's growth forecast for selected countries. Undoubtedly, countries like China, Japan, India suffers as American tariff increases, but so also United States. This is also reflected into their currency. The DXY index is representative of dollar against major global currencies. It is down from roughly about 111 to 98. 10% dollar is depreciated. When rupee depreciates 10%, our newspaper starts printing that. In America, they don't do this. Now, we have seen one trend that whenever dollar is weakening, foreign investors start selling American assets, which is quite natural. Americans have taken a lot of investment from foreigners. 20% of their equity market, aggregating almost $19 trillion, is owned by foreigners. 30% of US Treasury, aggregating $7 trillion, is owned by foreigners. $5 trillion of corporate credit, 30% of outstanding, is owned by foreigners. What if foreigners take this money out as dollar is weakened by 10%? More importantly, जो आया वो जाए, उसकी तकलीफ कम है, बट जो नहीं आएगा उसकी तकलीफ ज्यादा है. The US economy now relies on foreign savings. Without our dollar, they won't be able to survive. They won't be able to grow. तो हमारे पैसे बगैर उनकी गाड़ी भी लंबी चलने वाली नहीं है. The red portion shows American national net savings. The light dark gray portion shows foreigners' savings. And you could see how foreigners are financing America. Now, again, as I mentioned, tariff is double-edged sword. If American current account deficit comes down, that means they are importing less from the rest of the world. It will have direct impact on rest of the world, and which is why global growth is slowing down. Finally, this was one cartoon or a idiom which I found on internet. It was about Rome. The empire of Rome fell when it started more wars than it could handle, when greedy leaders started wasteful spending, and government tyranny and unpaid debt came together to collapse Rome Empire. All this are applicable to American Empire. And somewhere Vinash Kale Viprit Buddhi, their enemy number one is China. Their biggest supporter is India, and they are treating us as enemy rather than as a friend. Henry Kissinger, American diplomat, mentioned, to be America's enemy is dangerous, but to be America's friend is fatal. And now we are discovering that. Coming to Indian economy, can we withstand this tariff? Can we still survive this shock? Well, so far the headlines are mixed. We are doing reasonably well. But this tariff undoubtedly will have an impact, adverse impact on our growth. Whether it is 0.8%, 1%, 0.5%, time will tell. But there will be material adverse impact on India's GDP growth rate if tariffs continue to remain at 50%. Notwithstanding current scenario, now we are the fifth largest manufacturing country in the world, ahead of countries like South Korea, UK, and France. It's simply because our size is 1.4 billion people. Undoubtedly, whatever we produce for them is going to propel us higher. The good thing which we can legitimately take pride is that we haven't pledged our kids' future to create our present. Our debt to GDP ratio since subprime crisis has actually come down. Every other major economy in the world has increased their debt to GDP ratio. We are the only country which has reduced it by 4 percentage points. Corporates are deleveraged by 12%, household by 1%, and government obviously has borrowed. But overall, our debt to GDP ratio has come down by 4% between 2008 to 2025. And that is why market has re-rated India. The difference between 10-year Indian yield and American yield was 6% in 2014. Today, that is 2%. पहले उनका 6% होता था, अपना 12% होता था. अब उनका 4% है, अपना 6% है. The rainfall has been plenty this time, above average. Water reservoir levels are way above historical average. Kharif sowing is progressing well in most of the agriculture product. Rural employment, thanks to agriculture doing well, is now above pre-COVID level. Courtesy last year's monsoon and record food grain production, rural consumption is now outpacing urban consumption for last almost 12 months. Tractor sales, which is driven by agriculture, has been in strong trajectory. Urban consumers have become value conscious, while rural consumers have become more aspirational. Capacity utilization is consistently in 75% range. E-way bill generation has grown reasonably well. That means business activity is doing well. The GST collection, unfortunately, is not coming in line with nominal GDP growth, which is a cause of concern. In April to June 25, GST collection grew 6%. The nominal GDP growth was expected at 10% for FY26 in the budget. It is quite likely that its number will come down from 10% to somewhere around 8.5%. In the month of July, there is little bit of recovery. GST collections are up 7.5% YOY, but still well below budgeted nominal GDP growth and still below what we believe will be potential nominal GDP growth. So slowdown in GST collection is a cause of concern. The second concern is that while capex in absolute terms have gone up, it is driven more by state capex and center capex. The listed corporates are still very, very subdued. Their leverage has come down, and yet their investment is not picking up. Companies are happy to keep cash on balance sheet rather than invest in plant and machinery. The overall corporate debt to GDP ratio is still not aiding private capex recovery. When your entrepreneurs are not investing, you go to foreigners for investment. Unfortunately for us, while gross foreign investment is consistently above 70-80 billion dollar, net FDI has come down as many investors have started taking their money out. For us, the good part is oil. It has remained around 60-70 handle rather than going to 80 handle. ऑयल अपनी कुंडली का राहु और केतु है. ऑयल प्राइस ऊपर, हम नीचे. ऑयल नीचे, हम ऊपर. Private consumption remains below pre-COVID level. It is improving, but well below pre-COVID trend. Advance tax collection has been muted, partly driven by excess refund provided by income tax authorities, and maybe because now date for filing income tax return has been extended, I think, up to 15th of September. The other cause of concern apart from GST collection is bank credit and deposit growth that has come down from double digit to almost single digit, high single digit. The slowdown in credit growth as well as deposit growth is a cause of concern. Core GVA growth has also slowed down from 2023 peak. And more importantly, Dukalma Adhikmas, in drought, there is always additional month. Like that, we have been hit by unjustifiable tariff. The levy of tariff by US is in two stages. 25% made effective 8th of August. Another 25% taking it to 50% becoming effective on 27th of August. On 25th of August, American team is coming for tariff negotiation. Market is still hoping that better senses will prevail. And this 50% tariff, which should become effective 27th of August, will get rationalized. Whether that happens or not, Bhagwan ko malum. But at current level of tariff of 50%, auto component industry, capital goods, building materials like tiles player, EMS, which is electronics manufacturing sector, and textiles will be hit quite badly. Many companies will be at a disadvantage to countries like Bangladesh, Sri Lanka, Vietnam, Pakistan, Indonesia, Cambodia, who have got much lower tariff than us. Today, the highest tariff in US is levied on Brazil, China, and India. Sectors like chemicals, aquaculture, and consumables also will be hit. Pharma and oil and gas continues to remain out of the ambit of tariff, and IT services as of today is outside the ambit of tariff. Coming to equity market, last 6 months have been muted performance. Some stocks have done well, but overall there is some sort of subduedness in the market. Market cap to GDP ratio is 124% against historical average of 87%. But to some extent, this is justifiable because profit to GDP ratio is also at reasonably high level of 5% of GDP. We are now contributing 3.8% of global market cap, somewhere around what is our contribution in global GDP. So we are neither very high nor very low. We are in rightful place. The June 25 quarterly results were more or less in line with expectation. In sectors like automobiles, EMS, and metal, it came above expectation. And in sectors like oil and gas and real estate, it came below expectation. But against expectation of about 8% earnings growth in Nifty 50, actual growth has come at about 9.8%, more or less similar. In the large cap space, the gap is even narrower. In mid cap space, there is little bit of outperformance. With that kind of earnings growth, markets are broadly trading around its historical average in large and mid cap. The premium is about 12%. The small cap continues to trade at much higher premium of about 46% to historical average. The other way to look at the valuation in historical context is that the price to book is at about 10% premium against average of 2.8, 3.1. But the return on equity, sorry, this is not, yeah. The return on equity is also above average. Instead of average of 13.8, actual number is 14.9. So higher ROE is justifying higher valuation. Domestic institutional investors supported by distributors like yourself have been continuous buyer of Indian equity. On the other hand, foreigners, after 4 months of buying, have become sellers in the month of July. August also they continue to sell. Foreigners' behavior has been quite cyclical. Sometimes they are buying, sometimes they are selling. It just continues to move in a random basis. Courtesy they're selling since 2021. The overall holding of FPI in Indian market has come down to almost 16% against benchmark index of about 18.5%. So FPIs are now underweight India. From a global developed market versus emerging market, they also move in a cycle. From 1999 to 2010, emerging markets outperformed developed markets. But from 2011 to 2024, US market outperformed emerging market. Now, will the side turn? Will the tide turn? And will developed market start underperforming and emerging market outperforming? Last 5 years have been exceptionally good. Almost 296 stocks out of BSE 500 have delivered more than 100% return. In fact, 34 stocks have delivered more than 1000% return. Valuation of markets are not cheap. 215 stocks out of BSE 500 trade at a valuation of more than 50p. Earnings growth is good, but valuations are already pricing in a lot of positivity. In the 5 years between Jan 20 to July 25, broad market return was about 17% and small and mid cap return was about 23-25%. लोगों को ये देख के इन्वेस्ट करने का मन होता है, but it is our duty to remind that 15 years before last 5 years, broad market return was just 11%. Small cap delivered returns of just 7.5%. And large and mid cap delivered return of about 11%. Going forward, this kind of return looks extremely unlikely as our market is fairly priced. Returns are likely to range somewhere around here. People will have to moderate their return expectation while making investment. मार्केट पहले खरगोश की तरह भागा था, अब टॉर्टोइस की तरह चलेगा. Undoubtedly, there are enough volatility for our market. ट्रम्प साहब क्या करेंगे किसी को नहीं पता. डॉन को समझना मुश्किल ही नहीं, नामुमकिन भी है. FPI flows on odd days they are buyers, even days they are sellers. Indo-Pak tension right now is under control, but as we speak, Pakistani general is going to US. Consumption, rural consumption is doing well. Urban consumption is subdued. Geopolitical risks continue to hover. Hopefully, President Trump and President Putin are going to meet each other next week. कुछ ना कुछ अच्छा वहां पे होना चाहिए. And more importantly, earnings growth have started consolidating. from giving 15-20% earnings growth, we are now coming to somewhere around 8-9% earnings growth. All these things will make our markets volatile as well as less rewarding. What is our outlook? We still believe equity market is fairly priced, so neutral, natural weight. Large cap, little bit overweight because valuations are near historical average. Mid cap, marginal underweight because valuations are at little premium. In small cap, be very, very cautious. From an equity investment point of view, on a rolling return basis, our funds continue to do well over last 3, 5, 7, 10 years. Other equity funds have also done well along with hybrid funds. On a point-to-point basis, bearing small cap and mid cap fund where we have underperformed benchmark indices, rest of the funds we have outperformed benchmark indices, we have delivered more return than benchmark indices. Again, in equity and hybrid schemes, we have delivered similar performance. On a SIP basis, again, across most of our funds, we have delivered better return than benchmark indices. Overall, we are adding value to the customer and hence money is coming to our pocket. At this point of time, in current volatile scenario, large and mid-cap fund or a contra fund or a multi-cap fund is advisable. Sectorally, consumption sector and banking and financial services sector will do well. Both these sectors are not impacted by American tariff or exports. Coming to NFO of our Kota Active Momentum Fund, which opened on 29th of July and is closing on 12th of August. Rohit bhai, you are there. Will you take it up? I don't think so. Rohit is there. Okay. The fund manager who is managing this, Rohit Tandon, is probably not there on the call. But why are we launching this kind of fund? If you see Saurav Ganguly, he was Maharaja of offside. हर किसी की एक नेचुरल साइड होती है where they are Maharaja. But if Saurav Ganguly only played in offside, would he have lasted in international cricket? He had to develop ability to play on the onside. The same thing applies for fund manager. Some fund managers are value oriented, some are growth oriented, some are growth at reasonable price oriented. But you have to also play on your unnatural side in order to succeed in the market. Like Saurav Ganguly started scoring runs on the onside, albeit not as fluently as he was scoring on the offside. Same way, fund manager has to invest in those stocks and sectors where he or she may not be very comfortable. How do we make fund manager play on their unnatural side? Well, we do it through what is known as factor investing. It's a rule-based framework and it is focusing on making fund manager think and pick up those stocks which are not coming natural to him or her. There are various kind of factors: momentum factor, quality factor, value factor, growth factor. In the momentum, there are two factors. One is price momentum. भाव भगवान, भाव चल रहा है, आप गाड़ी में बैठ जाओ. The second one is earnings momentum. Stocks are slave of earning power. If company's profit goes up, if not today, tomorrow, prices will follow. We have launched earnings momentum fund, which is this active momentum fund all about. Here we will track what kind of earnings is declared by the company, what is analyst expectation from company's earnings, and whether these expectations are revised upwards or downwards. Based on earnings momentum, we will be building portfolio across large, mid, and small. Idea is to provide a factor-based investment to investors where fund managers' biases are controlled, restricted through rule-based framework. This fund is closing on 12th of August. It is meant more for conservative and average investors, as we will be investing on stocks where we believe earning cycle will be upgrading. We also have large portfolio of passive fund, and across most of our funds, we have one of the lowest expenses among the peer group. At this point of time, you can look at some of this kind of passive funds for your investment. On the fixed income side, American inflation has started inching up as tariff impact has started coming into play. The Fed has remained firm on not cutting rates because of rising inflation. And despite Trump saying Jeremy Powell is too late Powell, or sometimes even saying he is a moron, Jeremy Powell has withstood his ground. He has job until 2026. After that, God knows what will happen. The market is still expecting Fed to cut interest rates by 3 to 4 times by March 2026. Bank of Japan has kept their inflation, have revised their inflation outlook upwards, but kept their interest rates unchanged. In India, rupee is trading around its real effective exchange rate. Inflation has come down, and RBI itself revised forecast for FY26 inflation from 3.7% to 3.1%. The projection for current year is at 3.1%, which is well below RBI's mid-inflation target range of 4%. GDP growth forecast has remained at 6.5% for FY26, but with tariff coming into play, it could be revised downwards. RBI has been fairly supportive of growth through interest rate cuts and liquidity provision. Liquidity is awashed in the system, and keeping that in mind, the funds which should be suitable for debt allocation for a high taxpayer is Kota Income Plus Arbitrage Fund of Fund. 60% money is invested into medium duration debt funds. 40% is invested into equity arbitrage fund. And after 2 years holding, this gains will be taxed at 12.5%. This is one of the lowest tax rate for high taxpayers in fixed income space. People who are not high taxpayer could also look at hybrid funds. For regular cash flow, Kotak Debt Hybrid Fund or Kotak Dynamic Bond Fund will be appropriate. For high taxpayers, Balance Advantage Fund or Equity Saving Schemes will be appropriate. Gold is witnessing dream run. It's up almost 100% from 2021 levels. It is the best performing asset class in dollar terms in 2025, primarily driven by central bank buying of gold. World over, central banks have become like Indian housewife, buy gold and don't sell. In terms of currencies like dollar, euro, yen, and pound, dollar, the gold prices have moved higher, but it is still well below its peak of 1980. Gold ETFs in 2020 had reached one of the highest AUM. There is still room for gold in current cycle. Gold in terms of other commodities looks on the higher side. This is gold versus oil. At the bottom, gold is cheap and oil is expensive. At the top, gold is expensive and oil is cheaper. This is collection of research report from Oxford Economics and World Gold Council. Various interest rate movement by US Fed. What will be its impact on gold? They have tried to narrate. Essentially, they are saying that if interest rates are cut significantly, that will be positive for gold. If it is little less, then gold probably will have some amount of negative pressure. We keep a Google alert on whether artificial gold can be created, and this came up in one of the alert. There is a startup which claims to have cracked alchemy, whereby they are able to convert lead into gold. Obviously, the cost of making gold in this process is very, very high, and it is unlikely that they'll be profitable at this price of gold. But technology is evolving. If technology is able to make gold at much lower prices in laboratory like diamond, then gold prices will get impacted. Silver has a dream run. It peaked in the 80s at around $21, $22. Then it collapsed as Hunt brothers became bankrupt, and it took decades for silver to cross that. But somewhere in 2010, silver crossed its all-time high of about $22, and then it spiked up significantly. Undoubtedly, it corrected later on, but now silver is crossing its resistance level and moving further up. While it's difficult to predict silver demand and supply, the expectation on street is that silver from $38 is probably on its way to go towards previous highs of $40 to $45 kind of thing. This momentum as of today is very, very strong, and probably it's worth taking a trading punt on silver. Undoubtedly, silver calls are short term because there is a large amount of supply potential in silver from mining as well as processing. When you produce metals like zinc, silver comes as a byproduct. The demand for silver is essentially coming from electric vehicle industry, battery, and solar panel. And this has resulted into silver prices moving sharply in recent times.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.